Good morning, and as we head into the trading week of Monday, October 20, 2025, the U.S. markets are currently closed. We are looking at the closing figures from the last active session, Friday, October 17, 2025, for Nuburu, ticker symbol BURU. The stock closed the session at $0.34 per share. It was a volatile day, finishing up about 0.85%, but that small green candle hides the real story. Friday's action saw the stock open higher at nearly 35 cents, spike to 0.3549, and then get hammered down to a low of 0.3047 before finding that close. The volume on Friday was significant, clocking in at 98.75 million shares. But here is the immediate insight, the reality check that you won't get from a quick glance at the Robinhood app. That 98.75 million in volume, while looking massive for a 34-cent stock, is actually a catastrophic collapse in trader interest. It's a shadow of what we saw just a week prior. On October 8th, this stock traded an almost unbelievable 1.14 billion shares. Yes, billion with a B. The volume we saw Friday was a more than 90% reduction from that peak. The speculative frenzy, the short squeeze, the meme stock energy, whatever you want to call it, appears to be evaporating, and fast. This is the central tension with Nuburu. The expectation, the narrative that many traders are buying into using platforms like SoFi Invest or Robinhood stock trading is that this is a cutting-edge technology company. They hear blue laser technology and defense sector pivot, and they immediately think of the early days of a company like Nvidia stock, which leveraged its core tech into new high-growth markets. The expectation is that this sub-dollar stock is a lottery ticket, a 100-bagger in the making. People are doing their self-investing on investing sites and seeing a 52-week range that goes from 12 cents to nearly $1, and they're betting on the rocket ship. They're not looking at it as a serious investment for their individual brokerage account. They're treating it like a gamble. But the reality of what is happening under the hood at this company is something entirely different. The reality is that this isn't a growth story, it's a desperate survival story, a complete corporate overhaul happening in real time, funded by the very people speculating on its rise. Let's be direct. The recent transformation plan you may have read about isn't an expansion, it's a complete pivot away from a business model that has, to put it bluntly, failed to produce. When you look for investment help or do serious due diligence, the kind you do before putting capital into Fidelity mutual funds or Schwab intelligent portfolios, you look at the financials. And Nuburu's financials are terrifying. For the 3 months ending June 30, 2025, the company generated total revenue of nil, zero, nothing. During that same period, it posted a net loss of $12.2 million. This isn't a pre-profit tech company like Tesla stock was for years. This is a pre-revenue pivot. The trailing 12-month revenue is just over $9,000. That's not a typo. 9,000. So when you see the volume and the chatter, you have to ask what precisely people are buying. They aren't buying a business. They are buying a ticker symbol attached to a story. They are buying the hope that the company's new strategy to become a defense and security hub will magically create a viable business from the ashes of the last one. This new strategy is entirely dependent on acquisitions. This isn't organic growth. Nuburu is attempting to buy a future. They are in the process of acquiring companies like Techne and Orbit, trying to bolt on new capabilities to create this defense hub. They've spoken about Techne's potential $500 million order book, but that's Techne's potential, not Nuburu. And the integration of foreign defense companies is fraught with complexity and risk. This is a classic M&A roll-up strategy, often deployed by companies with a distressed core business and a high-flying stock price. The problem is that acquisitions cost, well, cash, and Nuburu doesn't have it. As of their last update, they had about $6 million in cash. That is not a war chest. That is a runway that gets shorter by the day. So where does the acquisition funding come from? It comes from you. It comes from the market. It comes from dilution. In the past year, Nuburu shareholders have been substantially diluted, with the total number of shares outstanding growing by an astronomical 1,793.6%. The company just completed a $12 million public offering in September. They are quite literally selling shares to the speculators on SoFi and Robinhood fractional shares to fund the purchase of a new business, all while the old business generates zero revenue. And then there's the corporate chaos. This isn't the stable, predictable management you'd find at Fidelity or Apple stock. On October 13th, Nuburu received another warning letter from the NYS American Exchange. Why? Because the company failed to properly notify the exchange before it issued a press release announcing a new dual CEO structure. Think about that. That is a fundamental failure of corporate governance. It suggests a management team that is either overwhelmed, inexperienced, or simply moving so fast to patch holes in the ship that they're forgetting basic compliance. They did regain compliance on October 16th, but the incident itself is a massive red flag for anyone doing serious online investing. This isn't the kind of behavior you'd tolerate from a holding in your Fidelity IRAs. This is the kind of behavior that precedes delisting. It's a sign that the reality is far messier than the expectation of a clean tech story. Many retail traders using a Fidelity mobile app or the Robinhood app might miss this news entirely, focusing only on the price. So let's tie this back to the recent volatility. That 1.14 billion share day was not normal. It was driven by the company's high short interest, which sits at nearly 17% of the float. This became a short squeeze target. Traders piled in, hoping to force a squeeze, and for a moment it worked, driving the price from the low 20-cent range to over 80 cents. But these events are temporary. The fundamentals, or lack thereof, are permanent. The squeeze peaked, the volume collapsed, and now the stock is bleeding out, down more than 50% from those highs. The company used that squeeze-induced liquidity to, you guessed it, sell more shares and raise cash. This is the cycle of a speculative stock. The speculators provide the liquidity that the company uses to dilute them, funding a high-risk business pivot that has almost no margin for error. This isn't online investment in the traditional sense. It's a high-stakes game of musical chairs. It's the polar opposite of a stable, intelligent portfolio strategy. Now, what did Nuburu actually do? The original promise was compelling. Their proprietary blue laser technology was designed to solve a real-world problem, welding reflective metals like copper. This has huge applications in e-mobility for welding EV battery components and in consumer electronics. Infrared lasers struggle with copper. Blue lasers, in theory, do it better. That was the original story. That was the expectation. But the reality, as the nil revenue shows, is that they failed to commercialize this at scale or beat the competition. So the new plan is to take that core laser tech and apply it to the defense sector. Think asset tracking, counter-UAV systems, and even missile defense. This sounds exciting, but it's an entirely different market, one dominated by established prime contractors and requiring immense capital and long bureaucratic sales cycles. It's a tough nut to crack for a company with $6 million in the bank and a history of compliance failures. This is a true binary bet, and it's not one for the faint of heart. This is a stock you buy through Fidelity Wealth Management or put in a Schwab Intelligent Portfolios account. This is a stock you trade on Interactive Brokers or SoFi Active Investing, knowing full well it could go to zero. The expectation is that you're buying the next great American tech company. The reality is that you are funding a distressed asset roll-up, a corporate turnaround attempt that is placing its survival on a high-risk M&A strategy. Given this pivot to defense, drop a comment below. Do you think Nuburu's M&A strategy will actually pay off, or is this just a last-ditch effort before delisting? Looking forward, the path for BUR is perilous. The bull case is simple. The acquisitions of Techne and Orbit are integrated flawlessly. Techne's supposed $500 million